Thursday, April 20th, 420 days. MBS were up 12 basis points early. Stocks were down 18. Long before jobless claims in Philly, Fed hit the wires. The producer price inflation index from Germany came in lower than expected, sparking a decent rally at the start of the European session. The U.S. economic data, especially the Philly Fed, has instantly restored the overnight strength with a bit of buying to spare. Jobless claims came in at 245,000 on a 240,000 forecast, which is actually good for inflation, although it's bad for everything else. Philly Fed business index came in at negative 31.3 on a negative 19.2 forecast. It was negative 23.2 previously. Prices paid came in at 8.2 versus 32.5 previously. So this all looks good for possibly inflation getting into line. The leading economic indicators of manufacturing activity are suggesting recession. Labor markets and consumer spending aren't, however, the unemployment rate is a coincident lagging indicator. Moreover, the Bloomberg recession indicator and the New York Fed curve-based recession model are at 55 and 60% respectively. Every time either model gets above 40%, a recession has followed since 1985. And for the New York Fed model, it's been accurate 7 out of 8 times since 1960. We also got existing home sales. They fell 2.4% in March, according to the National Association of Realtors. Sales were down 22% on a year-over-year basis. The median home price fell 0.9% on a year-over-year basis to 379,300. Days on the market fell to 29 days, although inventory is still very, very low. Confidence Board of Economic Indicators fell by 1.2% in March. The LEI fell to its lowest level since November of 2020, consistent with worsening economic conditions ahead. Basically, this plus the Beige Book information show deteriorating in recent weeks. All of this is indicating that we are getting a recession, which I've been saying for a while. There is no soft landing to this, folks. It's just going to be a hard landing. We're going to have a recession. Let's go ahead and get it over with. Inflation data in Germany and the Philly Fed Index in the U.S. provided a friendly 1-2 punch for bonds at 2 a.m. and 8:30 a.m. respectively. Nothing much happened after that. The LEI fell, like I said, to negative 1.2% from negative 0.5 last month. This is one of the most compelling recession warnings, if any, in recent data. The other day, we ended up 22 basis points on the day at 100.56. So being at 100.56 put us in the upper bounds of this range right here between the red flat line at 100.758 and the floor right here, which is the 50-day moving average at 100.39. We also got a post from our sponsor on wellthatmakesense.com. This is reading notes from our great book, Where Responsibility Equals Freedom. This is all about you are defeated in one tiny, seemingly insignificant surrender at a time that chips away at who we should really be. So this is something where you don't lose your goals all in one significant move. It's a whole bunch of little mini defeats and how to overcome them, how to prevent them. So check it out on our sponsor at wellthatmakesense.com.